The next session is about global minimum tax and digital service tax. A very warm welcome to you, Mr. Michael Keane. Thank you so much for joining us, despite the time difference. Thank you so much, sir.
Thank you.
Round of applause, please.
Well, thank you so much, and thank you very much for inviting me to this event. I'm sorry I can't be there in person. I'm listening to the sessions with great interest. Yes, so let me start by saying I'm an economist, so I'll be giving an economist perspective on the topics for this session, and really focusing on some notable features of the Inclusive
applause,
Framework
please.
Agreement, touching on digital and on the minimum tax, and some of the kind of unresolved issues that I see in the area. To start, we have to say that the agreement is really quite an astounding achievement, and it includes many elements that I think economists have been arguing for a long time. The element of formula apportionment, that is using formulaic methods to allocate taxable profits, basing some element of taxation in the market or destination country, stepping back from the arm's length principle, recognizing that that has some limitations and not using it in all circumstances. These are all things, along with the minimum tax, that various economists have argued for many years. And it's really been pretty amazing that many of these things were completely off the agenda 3 years ago or so. You could barely talk about them in polite tax society. And now here we are with this agreement. So you might think that economists would be very happy, but I'll come back to that question at the end of my remarks. So I did just want to say perhaps three things about the minimum tax. First issue has been for a long-standing question has been the issue of who's going to get the money, who's going to get the revenue from the movement towards a minimum tax. And as you know, of course, there's been a lot of agonizing over the rule order and the idea that really it would essentially be what we might think was the residence countries that would get revenue rather than source countries. In a way, for economists, that was always a rather perplexing debate because there was always the opportunity for the source country to essentially adopt domestic legislation that would preempt the application of the minimum by the residence country. So essentially grab the revenue for itself. So it's always sort of slightly perplexing to people like me why this was such an issue when the domestic source country can simply do it, move up to the minimum themselves. Well, of course, now we have the rather last moment, we have the qualified domestic minimum top-up tax, which kind of achieves precisely that. And it's sort of interesting for people like me because that's really a sort of a recognition that whatever people try to draft, at the end of the day, the economics comes through and drives the outcome. So I think we can see that's really a clear incentive that was there, finally belatedly being recognized. I think many of us would be happy that that is so. So that's a relatively straightforward issue. The second one, I think, has not been much talked about, but is, I think, important. And that's the question of, well, how do we think the high tax countries, by which I mean countries that are not directly constrained by the minimum tax, how do we think high tax countries will respond to the minimum? Do we think, for example, they will raise their rates, or do we think they'll lower their rates? Will the minimum become, that is, a ceiling, or will it be a floor? And, well, why does that matter? Well, one reason that matters quite a lot is because the answer to that question decides to a large extent whether the adoption of a minimum can actually be in the benefit of the low tax countries or not. That is, whether the countries forced to raise their rates might at the end of the day actually end up better off. Well, how could that possibly be? Well, suppose you're currently, prior to the agreement, you were setting a rate of, let's say, 12.5%, and now you're forced to raise your rate to 15%. Well, okay, you might not want to do that, ideally, because your best rate you thought was 12.5%. But nonetheless, it's not kind of a huge deal, perhaps going to 15. Nonetheless, you're probably going to be, slightly worse off, perhaps. Except that, well, what happens in the high tax countries? Maybe what's going to happen is the high tax countries, because you're raising your rate, the lower rates have all gone up. Maybe they're going to raise their rates, say, by 2 percentage points. Well, that's clearly good for you as a lower tax country. And so you have these two offsetting effects, the kind of the own effect and the kind of spill back effect from the other countries that may raise their rates. And there are good reasons to suspect that actually, if the minimum is not very high, it's that second effect that's going to dominate, leaving the low tax countries better off. So spelling out the argument, how the high tax countries react is pretty much critical for the interest of the low tax countries, and indeed looking beyond that to what the appropriate level of the minimum tax should be. The question becomes, well, how high could the minimum actually be and still leave low tax countries better off, as well as the high tax countries? Well, I don't actually have an answer to you for that question, I'm afraid, at the moment, but that's certainly something we're doing. I've been involved with some work on. But the key question comes back to the one I began with on this little remark, which is, well, how do we think the high tax countries will react? And, I have to say the empirical evidence on this isn't terribly clear. My own guess is it's not as clear as you might think. You might think it's obvious that the high tax countries will, if anything, raise their rates, just as in the past, they've lowered their rates as lowest rates have gone down. The more formal empirical evidence isn't so clear on that. Nonetheless, my guess, for what it's worth, would be that the high tax countries will indeed, if anything, tend to raise their rates. As a footnote, I should say, what does that actually mean? Well, it doesn't mean they actually, in terms of numbers, have to raise their rates. It means they set a rate higher than they otherwise would, which is a tougher question to verify in practice. So I'd be curious to know if participants in the conference have views on the high tax countries' reactions. But I really wanted to flag that as a critical issue that I don't think has received very much careful attention in the debate. People pretty much tend to ignore the reaction of the high tax countries, but that's, I think, pretty critical to how this whole thing plays out. A second issue, or third issue rather, to mention on the minimum tax is the impact. What is the impact going to be on real investment decisions? Now, in a sense, this is a question that's been there since the beginning of BEPS in 2013. That is, when you go about trying to close anti-avoidance routes, you're probably making it more costly to invest, and then you might expect investment to go down. And that's, I think, again, another issue that's sort of been in the background, I think, throughout the BEPS debate. But it's really, I think, only now, with the arguably more substantive measures of the October Inclusive Framework Agreement, it's only really now, I think, that that's beginning to attract really serious attention. There has, of course, been some work on that by OECD, with the implication that really the investment effects may not be that big, at least at a minimum of 15. At higher levels of the minimum, probably going to be rather more marked. But I think just 2 points I'd make on the real investment element. One is, of course, that we shouldn't pretend that we fully understand how taxes affect firms' investment decisions, at least in the sense of being able to quantify with great precision what the impact would be. Those are complicated decisions, and the literature is still really, I think, figuring out how taxes affect multinationals' investment decisions, both the amount and in which countries they invest. The second point I'd mention, nonetheless, is that we tend to think this is going to be bad for investment, and that probably is going to be the case, I suspect, in the countries that are constrained by the minimum. But we should also bear in mind that for some countries, of course, investment may go up. And why is that? Well, imagine you're currently deciding, prior to the agreement, you're deciding whether you're going to invest in a 12.5% country or in a 20% country. And you may think, well, okay, I'll invest in the 12.5% country because even though I think productivity, pre-tax profits are going to be lower in the low tax country, nonetheless, because taxes are lower, that makes it a more attractive investment for me after tax. So clearly what might happen is that as the 12.5% goes to 15 or whatever, then it's no longer more attractive to accept a less productive investment, a less profitable investment in a low tax jurisdiction, and you'll invest instead in, say, the 20% jurisdiction. The 20% jurisdiction may become, after tax, more attractive. So what is that saying? That's saying that, well, investment in some countries may go up as a consequence of the minimum. An implication of that, when you pursue it even further than I'm able to do now, is that, in fact, aggregate investment across the world may go up. Again, I'm not claiming that's necessarily the case, but I think I want to make the point that the investment effects are quite complicated, and for some countries, they may actually be beneficial in terms of the actual amount of inward investment. So with that, I think I'll wrap up just by returning to perhaps the first point I made. As I said that, well, many economists see elements in this package that they've been arguing for many years. The formula apportionment, moving back from arm's length pricing, destination, minimum. However, and as I say, it's a quite amazing achievement, and the rapidity with which the world has moved on these really fundamental issues has been quite, I think, breathtaking. But potential criticism is that well, clearly we know this is not a simplification. We know this is a complex set of arrangements. It's making things even more complex than they were before. And arguably part of that is because it lacks a kind of coherent vision of the overall approach to the tax system. You can see that, for example, we have elements of formula apportionment. We have elements of destination basing. If you look at the literature, those have not been things typically that go together. They've been seen as alternatives, particularly in the form of the destination-based cash flow tax. So now we have both these elements, along with the minimum. And, I think, again, I just have to say what an amazing achievement it is. If economists are going to be a little bit critical, they might say, well, okay, where's the overall coherence in this package? What do we really think the international tax regime should be doing? And of course, the question then becomes, well, how sustainable is this? And that's really saying that the complexity isn't there because we're doing a coherent thing in a complicated way. The issue may be more, well, is this really a coherent approach? And how sustainable will it eventually prove to be? So I think with that, I'll close my remarks and thank you again for inviting me. And I look forward to hearing the rest of the presentations. Thank you.
Thank you so much, Professor Keen, for joining us today for this very, very special TIOL Congress technical session. To invite Ms. Shefali Goradia, partner Deloitte Touche Tohmatsu India LLP, to please share her views regarding the subject.
Thank you. Good evening, everyone. We've just heard Professor Keen talk about the BEPS changes that have happened, Pillar 1, Pillar 2. And as many of you already know, this has been the whole tectonic shift in how countries are going to tax incomes of foreign companies that do business in their countries. We are also moving away from the whole classic notion of permanent establishment, which was if you had a physical presence in a country, then you would pay tax in that local country. But now we have a new nexus in the form of the market. So if you have a market in a country, then that automatically becomes your nexus. And as a result, you will end up paying some taxes, regardless of whether you have physical presence or not. So all in all, I think this is a huge shift from where we were, just till like few years back. The BEPS, which is the base erosion and profit shifting, which got exasperated by the digital businesses, has now actually become all-pervasive. So, for example, in Pillar 1, where there is a reallocation of profits, surplus profits to the market jurisdiction, that is not only limited to the digital businesses, but it applies to all businesses. So, for example, the top 100 companies today in the world, which are the top largest multinational, crossing the threshold of 20 billion euros, are all within this Pillar 1. And with the possibility that this threshold will be lowered as we go further, so that it will become more pervasive, and it will start impacting many countries. I think we've often heard that, countries like India, does it really matter? How many companies are we talking about? Today, we see a lot of foreign multinationals with Indian subsidiaries that are impacted. But besides that, it is soon going to be covering many other companies as well. Likewise, while we are at the policy level, it is also good to know that under Pillar 1, whatever is the excess profit that gets allocated to the market, it gets collected and paid up in the headquarter country, and then it gets redistributed to the market jurisdictions. And now we have the draft rules, which are the detailed revenue sourcing rules as to how would you go about allocating the profits. And for different types of business models, there are different rules on revenue sourcing. And I think as in this session, I think we are following the lead of indirect taxes. So for most of these business models, the revenue is sourced where your customer or the user is based. So for example, if you have an online, say, advertisement business, then the revenue is sourced where the advertisement or the viewer of that advertisement is based. And there is a certain rule order in terms of how will you go about finding where is the viewer actually located. Likewise, if you have marketplaces, which are the intermediaries, whether it is a sale of tangible goods or intangible goods, then there is a preset rule that 50% revenues get allocated to the purchaser jurisdiction and 50% revenues get allocated to the seller jurisdiction. For cloud services, it gets even more complex, where there is a different rule, whether it is a B2C transaction or a B2B transaction. For a B2C transaction, again, the revenue is sourced where the consumer or the client is located, whereas for a B2B transaction, you have to look at where are the services actually being utilized. So all in all, I think this revenue sourcing rules are fairly complex, but we are getting down to that detailed implementation level framework for it. And once the rules are finalized, that will lay out the broad formula as to how the profits need to be reallocated. I think especially in Pillar 1, it is important that the data which is collected is reliable, and which is where one of the big asks from the industry has been that try and use the data which is already collected. Like, we talked in the previous session as well, right? The GST is already giving you certain data. Likewise, in many other European countries, the VAT laws already collect the data. And if that data can be reused for this purpose, it would lessen the burdens on the companies to shell out extra data or to go and approach the customers or the users to get this extra data. It's also, the ask of the industry to keep it simple and administrable. A noble ask. Nobody would deny that. But the more in detail we are going, I think we are moving farther away from it. But at least the collection and the distribution mechanism should be simpler, since it is going to be administered at a country-to-country level. It is also interesting that equalization levies or the digital service tax, which will be withdrawn once Pillar 1 is implemented, the equalization levy has to be adjusted against the Pillar 1 profits that are to be paid in the market jurisdiction. So for the first time, we are seeing some kind of a mathematical trade-off where they are agreeing to collect the taxes in the interim period, but they would also set it off against the Pillar 1 profits. So that is about Pillar 1. Now coming to Pillar 2, which is the global minimum tax of 15%. There the threshold is lower, which is 750 million euros. But again, we are seeing that most of the data which is being collected is based on the CBCR. So just to take it forward in terms of what are we seeing, what are the companies really doing in order to prepare themselves for this Pillar 2 readiness or a Pillar 1 assessment. And most of the times, as we see, the first step is to go and look at what your data is. Is it robust enough? Does it give you all the parameters that are being sought, both under Pillar 1 and Pillar 2 proposals? Or if not, can you really amend your systems to collect that data so that when it is implemented, you have this data readily available and consistently available across all the jurisdictions where the multinational has its operations? The second level of preparedness is about the impact assessment. And, like Deloitte, many other firms do have this kind of tools which help you in doing this impact assessment, where you can run the whole, your data through this tool and see how much is the additional tax impact in which jurisdiction, both under Pillar 1 as well as Pillar 2. We are yet to see the final set of rules for Pillar 2, so we'll still have to keep amending and preparing for it, but at least it gives you the first level of idea. Then based on your impact assessment, the next thing that the companies are doing is re-evaluating the business models. So for example, if you have your R&D center, say somewhere in Europe, whether without the incentives, are you going to survive? Or is your data center or is your R&D center still doing the value addition from that jurisdiction? Or would you rather move it where you have your rest of the DEMPI functions located? Likewise, the regional headquarters or the regional IT hubs are also being re-evaluated with this lens of matching them with the talent functions and matching them with the commensurate profits that can be justified in those jurisdictions. In order to calculate this jurisdictional effective tax rate, again, you do need help of some kind of a tool, because that is what will show up whether are you falling short in some jurisdictions. And many countries around the world have already started adjusting the tax rates. So for example, we are seeing that Cyprus has announced that it will raise its rates up to 15%. UAE has announced for the first time that they will be imposing a rate of 9%. And now we are seeing very targeted and focused changes. So the rate of change or the new rates will now apply to a targeted set of companies that are going to be impacted by Pillar 1 and Pillar 2. And then as that bracket keeps expanding, maybe these rates will then apply to the larger set of companies. So these are targeted reforms that are happening. Likewise, we are already seeing countries like Netherlands that have announced the intention to include an income inclusion rule in the domestic tax law. And same is likely to be the case for India as well. Since we don't have a controlled foreign corporation rule, we may also see income inclusion rule under the Indian domestic law. And many other countries around the world, especially in Asia Pacific, that used to give a lot of tax holidays and incentives, are re-evaluating what substitutes can be given, which will balance out things between, keeping your effective tax rate at 15% at the same rate, remaining an attractive tax regime for the foreign companies to be attracted. So overall, we are going to see a lot of changes in the upcoming years, starting 22 itself, where throughout the year, a lot of new rules and frameworks will be announced. The model commentaries will be announced. The model changes in the domestic law will be announced. And then 23 is the announced year for implementation of both Pillar 1 and Pillar 2. And that is going to pose interesting questions in terms of how does all this get juxtaposed against your traditional permanent establishment. Whether the physical permanent establishments will still be relevant in the upcoming tax world, or is it going to lose its relevance? Maybe we will hear more about it from our chairman, but with that, I would like to end my talk. Thank you very much.
Thank you so much, Ms. Shefali Goradia, for sharing your thoughts. Moving ahead with this technical session, we would now have a very special video play out sent by Mr. Alok Kanti, President and CEO, Bayer Inc., Canada. Can we have the video, please?
Good afternoon, colleagues. It's a pleasure to be here and speak at this important conference. I guess I'll be one of the few non-experts who will speak today, and in reality, I will be reaching out to most of you in the audience to understand and get help on tax issues. But firstly, a bit about myself. I grew up in India, in Darjeeling, and subsequently studied at the Delhi College of Engineering, and have since worked with Bayer for the last 28 years. I have lived in 7 countries, including the US and China, and worked in over 28 jurisdictions. Currently, I'm the CEO of Bayer Inc. in Canada, but today I'm expressing my own independent views. The topic I was asked to talk about is global minimum tax and digital service tax, demystifying Peep. It's a wonderful opportunity to present a business generalist view on tax reform. Before I go there, let me firstly share my perspective of taxation of companies per se. I go back to a story my finance professor at the University of Southern California opened his class with. The story goes, the CEO of a company asked a team what 2 plus 2 was. The marketing colleague said he could make it 5. The engineer said it was perhaps 4, depending on the level of certainty the CEO wanted. And the finance colleague asked, before tax or after tax? The story has always struck me as highlighting that taxes are instrumental in corporate strategic decisions. Mathematically and in project finance, they are a significant contributor to the weighted average cost of capital, which in turn affects the net present value of projects. Policymakers should remember the impact of taxes and that it affects all decisions of the company, be it the ability of a company to take on risk in marketing expansion, in capital allocation, or in innovation. It also affects operational decisions by impacting decisions on pricing and wages when viewed over the longer term. In short, it plays an integral role in key strategic and operational decisions of a company. Moreover, it plays an important role in defining a company's relative competitiveness when compared to competitors in other jurisdictions. So coming to the point of the tax reform. Firstly, who decided what? On October 31st, after about 6 to 8 or even more years of work, the heads of the world's major economies, the G20 nations, approved a new global minimum corporate tax. This deal, announced at the G20 summit in Rome, is historic since this is the first time nearly all nations have agreed to such a system. Earlier, on October 8th, some 136 countries had endorsed the new regime. To quote Mr. Matthias Cormann, Secretary General OECD, this is a massive and historical significant reform, which will make our international tax arrangements fairer and work better in a digitalized and global world economy. This agreement addresses two issues which have been a source of ongoing debate for a long time. Firstly, a differential approach by jurisdiction in response to the digital economy. And secondly, a base erosion and profit share shifting as some companies have moved to lower or extremely low tax jurisdictions. The system thus aims to give more stability to international tax rules. Secondly, what is it? So let's delve a bit more into this. The agreement has two pillars. The first pillar reallocates tax between countries to where they earn their revenue. Under this, companies' excess profits, defined as in excess of 10% of total revenue, will be taxed at 25%. This reallocates taxes to countries where revenue is earned. To quote an expert, it is important that tax is paid, but it also matters where the tax is paid. The second pillar ensures that large multinationals pay a minimum level of tax and lets governments target profits that are taxed under a minimum corporate rate of at least 15%. Governments could set whatever local corporate tax rate they want, but if a company pays lower tax rates in a particular country, their home governments can top up their taxes to the 15% minimum, reducing the advantage of shifting profits. So it creates a floor, if you like, and that reduces a race to the bottom tax competition. These rules are applicable to large companies, with Pillar 1 to companies with Euro 20 billion in sales, and Pillar 2 to companies with greater than 750 million euros in sales per annum. That said, I would like to leave you with three thoughts. Firstly, companies should pay fair taxes. Tax is an important contribution to society. A well-functioning tax system builds the very infrastructure that strengthens a company's competitive advantage and provides resilience to the economy, be it investments in security, infrastructure, education, or basic research, to name a few. For example, the Canadian government paid subsidies of over 100 billion Canadian to ameliorate the economic impacts of the COVID pandemic. As another example, the mRNA technology, which is the basis for some of the vaccines that have helped us out of this pandemic, was initiated through the basic research funded by the NHS in the US in the 80s. Companies should carry their fair burden of taxes and in a global enterprise pay them appropriately in jurisdictions where value is added, either through innovation, management presence, manufacturing, or commercial sales. However, all competitive advantage is relative, and thus everything else being equal, the difference in tax rates between countries can create the competitive edge that companies are constantly seeking. This fundamental principle will be better obeyed with the global minimum tax. However, I do hope that this move is not misused or results in a noticeable increase in tax burdens for companies that comply, as I've already talked about the close relationship between taxation and strategic investment decisions. Secondly, taking a long-term view, we can quite well see taxes being paid as a component of ESG of companies. As mentioned earlier, taxes are an important contribution to society, and ESG reporting and ratings are becoming increasingly important. And over time, one can anticipate that they may be also seen as a differentiator. Tax transparency is now backed by global institutions, including the UN, OECD, and EU, and being discussed by others. Over time, companies could share tax payments as part of their ESG. Thirdly, tax complexity can create a significant incremental burden and risk on companies, as most multinational companies would try their best to follow the law while optimizing tax. However, if new tax ideas are put on the table while old complexity is not removed, all you get is a higher cost of compliance. This burden should be fairly evaluated by governments as they implement these new tax approaches. We can anticipate further complexity to be added through government regulatory or tax-based mechanisms to manage climate change. So we can anticipate further complexity as we come in, and we hope, or at least I hope, that governments and bureaucrats are cognizant of the complexity this creates. Putting it all together at the end is that these two pillars are significant achievements of global tax regulation and reform. They address the growth of digital economies and potentially arrest the race to the bottom on relative taxation. Complexity in implementation remains. However, I'm optimistic it will achieve its objectives. Thank you, and trust you'll have.
Big thank you out there going to Mr. Alok Kanti, President and CEO, Bayer in Canada, for sharing this video with us. And now it's time for me to invite the chair of this session, Mr. Pramod Kumar, Vice President, ITAT, to please share his observations and concluding remarks. Mr. Pramod Kumar.
Thank you so much. Thank you so much, Shalin, for inviting me and for making me part of this very, very interesting discussion on Pillar 1 and Pillar 2 proposals. And insights from three panelists who come from different backgrounds. The economic perspective given by Michael Keane, I think that's very fascinating when he talked about shifting from arm's length price to the formulary apportionment. And that is something which was on the cards for a long, long time. I think I've been reading for at least last 15 years as to how irrelevant the arm's length price considerations could be in times to come. So that's one way of looking at it. The other way of looking at it, I would have thought was in the shifting basis of taxation. Because if you see how taxes have evolved over last few centuries, I would say, it has been a journey from kind of a protection money to the traders who had to go to different places. So for the protection of business, to compensation for the services rendered, where the capital resided, to now the economic opportunities. And when you bear this in mind and you think of how Indian source rules were subjected to, I would say, ridicule, sarcasm, and even criticism by the global community, I would think that Indian source rules were quite, ahead of their times. And today, in a limited way, though, it's a recognition of the source rule, because when you look at the market economies where the products are eventually marketed, that is, I would think it's kind of a source rule. And when Professor Keane talked about the impact of the anti-avoidance rules and the complex dynamics of the, impact of these things on the investment decision making, that was really fascinating. And all of us must see this from this perspective also. It's not a cause and effect relationship that you have this solution and this is taken care of. I would go a step further and say, and I would agree with Professor Keen when he shared his skepticism or his doubts about what the road ahead is going to be. That today, the solution that we have, particularly in Pillar 1 with respect to the taxation of digital profits, is not a solution which is sound on the first principles. It's a compromise solution, but there is so much of money involved in it that no tax jurisdiction can give it up. So it must have been quite tempting for the market economies not to say no to this offer. But then there's a rider. When you reach a settlement which is not based on the sound principles, history tells us it's only a stepping stone for some other solution. And there I would share the vision of Professor Keen that maybe in times to come, we'll have to see how it evolves. Shefali made a very interesting point, and I think I'm entirely with her when she says that today, when you look at the Pillar 1 proposal, as a matter of fact, it's kind of she didn't put in an as harsh word, but I would use those words, that it's an abandonment of the PE principle by not updating it to be in tune with the times. Now, you have to understand this PE, the very concept of common establishment, which has been basis of the full-fledged taxation, what you call residence type taxation, is something which is on the foundation of the international tax principles. Now, instead of updating the permanent establishment definition and making it more in tune with the ground realities in today's business model, we have kept that proposal aside, and now we are going for a new concept, that is the concept of digital, taxation of digital economy. How long will we keep the PE as something confined to brick and mortar models? How long will we ignore the fact that even a virtual presence is a presence? I mean, it is as good a presence for all practical purposes as a physical presence is. I would think that, and remember, if you decide taxation on the basis of virtual presence versus physical presence, then it violates the fundamental principles of neutrality. So you infringe the neutrality when you differentiate this from this. So I would think that the road ahead seems to be very interesting and quite interesting. Do I have a couple of minutes to complete my remarks?
Sure, sir. You have time.
Thank you very much.
Yeah, you have
Thank you
time.
very much. Thank you. Now, that was the second point I wanted to make. Now, third thing which I must talk about is the complexity of the nexus rules, which is what Shefali talked about. I think this is fairly complex, and what it really mentioned about is and when you see the nexus rules, as a matter of fact, these are these rules which I would think, I mean, for people of my generation, which are modified versions of the source rules. So there's still complexity, a lot of work to be done. And then when you talk about adjustment of the equalization levy in the transitory period, particularly, for example, the Indo-US agreement, which has been arrived at. Now, at this stage, it would not be proper to talk more about it because we do not know as to how the law about taxation of the digital economy is going to be. What we have seen now is just a template. And this is a lot of work for our policymakers on how to implement. But then it will be fairly interesting. Now, Mr. Kanti's perspective, which was perspective of a corporate person, was indeed very interesting. On one hand, he talked about competitiveness. On the other hand, he has his apprehensions about the cautions. And once again, the point that he made was very interesting about the importance of these rules in the strategic investment decision making. It is not as simple as a relationship as sometimes it's made out to be. Of course, there are minor things which I must correct Mr. Kant when he talks about taxation at 25%. It is not taxation at 25%. It is 25% of the profits in excess of 10%, which are to be allocated to the market jurisdictions. Now, just two more thoughts which cross my mind, and that is, about the global minimum tax. Now, as far as we talk about 15% tax, This is something new because now we need an income inclusion rule. And as Shefali very rightly pointed out, in the absence of group taxation that we have in India, it's absolutely necessary that unless you have the income inclusion rule where your subsidiaries have not been taxed on country to country basis at 15%, how that income is to be included in your. So once again, we have some interesting times, for the lawyers and for the academicians to watch as to how these things evolve. But these two things, when you have the income inclusion rules and the undertaxed domestic rules, which are going to be part of the domestic law, and of course, subjective tax rules, which are relatively simple and which can be brought about by the treaty provisions. So, these things this is what will define what the practical dynamics of this is. But on a very personal note, before I conclude, I must say that it has been a very interesting journey for me personally to witness these paradigm shifts. We have seen the changes, when I think of the days when Azadi Bachao Andolan judgment was delivered, where double non-taxation was accepted as a part of life, to the days of BAPS 1, where we saw how the segregation of economic activity and taxation was sought to be nullified, to the times when we are talking about a minimum level of taxation in each country where the economic activity is carried out. So it's quite a task for anyone from my generation to reconcile to these changing value systems. And in the same way, I would think that even with respect to the taxation of digital economy, when I wrote my first decision on this in Right Florist, that was about a decade back, and when I was writing the judgment, I can tell you today that my concern and my frustration used to be as to how irrelevant is the PE definition. I mean, that was 10 years ago. So how irrelevant it is today is degree certainly far more. To the times when PE definition itself has been discarded and we have gone for a different goalpost. But what we don't remember is that, if you have the PE concept which takes into account the virtual presence, then taxation is not of the super profits. The taxation is of the entire profits. And then taxation is on altogether different basis. I mean, it's a mystery to me as to how do all of us, when we talk about ethics and neutrality, when we talk about the fairness, and as Mr. Bajaj was saying this forenoon, that you have the voices which are only go in this direction. How, despite all this, nobody realizes that what is the loss which has happened? How that a tax rule which was developed 100 years ago. I heard somebody say the other day that everything which was invented 100 years ago is in museum, except the international tax rules. And I would think PE definition is also one of them. How, instead of reforming those tax laws, we keep on shifting the goalpost, we keep on going to new things. But then, as everybody, as I get to know from the people I talk to, there is so much money in this that it is difficult to resist this kind of temptation. I think, with this, I would conclude, and I would thank you so much for making me part of this very, very fascinating discussion. Shefali has, the practitioner's perspective that she has given is absolutely amazing. And Professor Keen, that was very, very thought-provoking, as economics always are. And to balance them all, we had Mr. Kanti to talk from an economist perspective as to how things should be. I'm absolutely delighted to be here. And I must thank you once again and wish you all the very best in the remaining sessions. Thank you, Mr. Shalin, and thank you, Shefali. Thank you, Professor Team. Thank you, Mr. Kanti. Thanks a lot.
Thank you to you, Mr. Pramod Kumar, Vice President ITAT, for taking time out of your busy schedule and being here with us to chair this very special technical session on global minimum tax and digital service tax. Big thank you to Ms. Shefali Goradia for being here to share all her insights.